Market risk, whether trading options or stocks, there's no risk-free return possible. No trading strategy. Mechanical trade, no trade type or method of trading that avoids having to take on risk of loss and at times, actual loss. There can't be a trading market if there's no risk to investing. So risk is the price of entry to be in the market. If we're going to trade over a long time, large downward market and price moves, corrections and perhaps crashes will happen. Maybe tomorrow, maybe in 10 years' time. No one, not even the world's best investors, will be able to accurately predict the timing before the event or even see its impending coming. Any stock or market index can fall 50% or more under adverse conditions. All option trade types and strategies have weak sides to them, and it's important to understand what the worst outcome is going to be in a perfect storm. What happens to a trade in its worst downside event? Where does risk lie in a wheel strategy? A worst-case scenario trading the wheel in a perfect storm is being assigned in a big market down move on all open options positions at prices so far below the assigned strikes as to not be able to write any covered call trades against any of the stocks held. At that point, we're no longer an option trader but a buy and hold growth stock owner. Unless or until price improves enough for a CC right, or perhaps we implement an adjustment strategy. Most other options strategies risk total or major loss of portfolio capital on all open positions in an unexpected correction or crash scenario. So the risks trading a wheel type strategy aren't severe by comparison. The downside risk to our wheel trading strategy is the potential loss of opportunity to make income for a while, depending on how much premium has already been collected over the trading year. Our portfolio may or may not show an overall unrealized loss when assigned on all positions because the market has fallen. It's a bad idea to be selling stock near lows which can't be timed or actually known. For example, Warren Buffett called the low of the financial crisis too early. We must hold those stock positions for as long as it takes, as should any buy and hold investor, until price comes back, as it has from all previous market corrections and crashes. Holding stock through the bad times as Buffett does works out because the bad times have never lasted. The market has always come back, then gone higher. That's not going to change. However, trading the wheel will also have choices in how to adjust our positions to improve and even profit from the situation. Being out of the market as an option trader for X amount of time is the worst downside cost here, as compared to losing most to all capital in all open trades, which is the maximum risk with most other options strategies. Wheel upside risk. Upside risk might be to miss out on more profitable large stock price up moves, which sometimes happen on high IV stocks in bullish markets for growth stocks. It sometimes would have worked out more profitable to just have bought and held the stock in return for mitigating the downside on a put stock by way of earned premiums. We're sacrificing at some points the full extent of upside stock gains that a buy and hold investor might see. The aim of this option trading strategy is steady and consistent income accumulation rather than a guessing game on stock price speculation, which is very hard to time. Collecting premium mitigates risk, whilst the goal is not to own discounted stock but to earn steady monthly income over years. Nonetheless, in a worst-case scenario, any big downside stock move is mitigated by premiums already garnered trading options against a stock. Given enough time to make enough successful trades, we'll collect enough premium against a stock that we regularly trade to reduce downside risk ever more. It provides a margin of safety similar to buying stock at a discounted valuation. Some traders' approach is to collect X number of premiums, primarily selling CSP against the same stock, until the total amount of premium received over time adds up to the current market price of the stock. At this point, it could be said that the stock is free, paid for by the income accumulated from the option trades. Maybe that would apply if the strategy at that point was to own the stock and hold for future potential stock price gains. The strategy here, though, is to continuously trade the wheel long-term for ongoing income. Since a good year trading our version of the wheel can see up to 50% plus portfolio return, our profit-taking strategy is to take profits off the table after a maximum of 1 year's trading. It could be that after a year or so trading the wheel, an unlikely worst-case 50% haircut to the portfolio value is covered by gains already banked. Buffett has seen his portfolio down as much as 50% a number of times. We don't want to see prior gains lost in a correction or crash, but the now likely primarily stock-owning portfolio, showing an unrealized stock price loss, is a paper loss only as long as, like Buffett, we hold and don't sell the stock. We don't own an index, are not widely diversified by stock. We own growth stocks, largely small caps, which may or may not be slower to recover. Hopefully we chose our businesses well based on their fundamentals. It's a matter of time, waiting for the market to recover, expecting to see our full portfolio value eventually restored. The indexes have always come back and then gone higher, perhaps a rare worst outcome, outlier downside event occurred, yet over the longer duration of good year, bad year returns, overall, over time, the wheel, at worst, thanks to the continuous accumulation of premium, most likely performed significantly better than market index returns over the same period.